You ever wonder how that 10-minute grocery order actually gets to your door so fast? Well, it's definitely not magic. It's a massive, behind-the-scenes logistics engine. And today, we're diving deep into the company that powers it all, Shadowfax, and their brand new IPO. So the real question for you is pretty simple. With their IPO dropping, could this be your next big investment opportunity? We're going to unpack the numbers, the story, and everything you need to know. All right, before we jump into the money side of things, let's get a handle on what Shadowfax even is. Think of them as the invisible engine, the secret sauce, behind a ton of the brands you probably use every single day. Okay, so they're what's called a third-party logistics company, or 3PL. Look, that's just a fancy term for saying they handle that super critical final step, the last-mile delivery. They're the ones bringing the packages from e-commerce giants like Blinkit, Amazon, and Flipkart right to your doorstep. But what really makes them stand out from the crowd? I mean, what's their secret? Well, it all boils down to their business model. It's a total game changer compared to the old-school courier companies, and it's the key to their absolutely explosive growth. So get this. The company was started back in 2015 by some grads from IIT Delhi, and they built it on something called an asset-light model. What does that mean? In simple terms, they don't own a giant fleet of trucks or bikes. They don't have all that overhead. The easiest way to wrap your head around it is this. It's basically Uber, but for packages. Seriously, just like Uber connects drivers with people who need a ride, Shadowfax connects delivery partners with stuff that needs to be delivered. It's a brilliant model, really, because it lets them scale up like crazy without spending a fortune on buying thousands of vehicles. And, does this model work? Well, the numbers speak for themselves. We're talking over 1.5 million. That's 15 lakh deliveries every single day. And they're doing this in over 2,500 cities all across India. That's just massive. Okay, so that brings us to the million-dollar question, right? Why are they going public now? This is where things get really interesting. We're about to get into the bull case, the super optimistic, explosive growth story that Shadowfax is selling to investors. All right, let's talk numbers. Here are the key details for the IPO. They're aiming to raise over 1,900 crore rupees. The price band for a single share is set between 118 and 124. So for a retail investor like you or me, the minimum buy-in, one lot, is going to cost you just under 15,000 rupees. So where's all that cash going to go? Well, a pretty healthy chunk, 1,000 crore, is fresh capital. That's money they'll use to fuel even more expansion. The rest of it is what's called an offer for sale. This is basically the early birds, the initial investors, like Flipkart, getting a chance to cash out on what's been a very, very successful bet for them. And you can really see that growth story in their revenue. I mean, look at this. It jumped from about 1,400 crore to almost 1,900 crore in just one fiscal year. That's not just growth, that's a massive leap. But honestly, maybe the most important number for any potential investor is this one right here. We're talking about a dramatic turnaround to profitability. They went from losing over 100 crore to being EBITDA positive. In the IPO world, that's the classic signal that says, okay, we're ready for the big leagues. And that number, that 33.4% year-over-year growth, that is the absolute heart of the bull argument. It's what makes Shadowfax the fastest growing logistics player in the entire country, and it's exactly what has investors so fired up. Okay, but hold on. Every story has two sides, right? Now we've got to flip the coin and look at the part that should make you pause. All of that incredible growth, well, it comes with a really, really steep price tag. Welcome to the bear case. So the valuation, it's high. We're talking extremely high. Based on their annualized earnings, the price-to-earnings ratio, the PE multiple, is sitting at around 200. Let me just say that again, 200. To put it mildly, that's expensive. And just to give you some perspective on that 200x number, most high-growth tech companies traded a PE of somewhere between, say, 40 and 60. So yeah, you are paying a massive premium for Shadowfax's future growth story. And this is where the trade-off becomes crystal clear. Let's compare it to its main rival on the stock market, Delivery. Sure, Shadowfax is growing nearly 3 times faster, but its valuation is way, way higher. You're essentially paying a huge premium for that speed. And here's the real risk that's tied to that sky-high valuation. Their profit margins? They are razor thin. We're talking paper thin. What that means is there is practically zero room for error if they want to keep this profitability going, let alone grow it. So what does this all mean? Well, it all builds up to the central dilemma for anyone thinking about investing. It's that classic Wall Street showdown: incredible growth versus a sky-high valuation. Look, this is really what it boils down to. On one side, you've got this super exciting, high-growth company that's leading a booming market. But on the other side, you've got a very, very expensive price tag attached to a business with those tiny razor-thin margins. So let's be clear. The debate isn't really about whether Shadowfax is a good company. I mean, by all accounts, what they've built is incredibly impressive. The real question is it a good investment at this specific price? That's the core of the whole bull versus bear argument. And ultimately, your decision to invest or not to invest really comes down to this one big question. Are you willing to pay today's premium price for the promise of tomorrow's hypergrowth? It's all about weighing that incredible potential against the very real, very high cost today. And that, of course, is a decision every single investor has to make for themselves.